And the U.S. job market stayed strong in June despite record high inflation and fears over a possible recession. According to the Labor Department, employers added 372,000 jobs last month. That's 100,000 more than what economists had predicted. The unemployment rate remains at 3.6%. For more, I want to bring in Akin Oyedele, who's an investing deputy editor at Business Insider. Thanks for being with us. This is a very positive jobs report, but could it also create more inflationary pressure? Meaning, could people who are working more have more money to spend on limited goods and services?
Yes, it can, Catherine. And in fact, one of the things we learned this morning was that wages grew 5.1% year over year. And that's a still rapid pace. And so it is concerning for the inflation picture, because what happens is that when companies raise wages, they compensate somehow. And one of those ways is by raising prices. And so, yes, it is possible that, hot inflation is not completely behind us for now.
So it appears the Fed has been aggressively raising interest rates. What do you think the ceiling is? A former government official told CBS News today that he thinks it's about 5 or 6%. What are your thoughts?
Well, I wouldn't quite put a number to it, but I do think that the Fed is very cognizant of the fact that they might push the economy into a recession by raising interest rates. That is the big concern among a lot of economists and experts that I talk to, which is that, by slowing the economy, they could end up not achieving what's called a soft landing, which is when they're able to raise interest rates without necessarily pushing the economy into a recession. So after the jobs report today, a lot of expectations are for another big 75 basis point rate hike later this month, like they did in June. And that would be sort of the second time in rapid order. So the Fed is being really aggressive, and the risk is that, that could tip the economy into recession. But they're very aware of that, and I'm sure they are aware that, that'll be a point of pain for many Americans, for sure.
This anticipated rise of another interest rate hike, maybe 0.75. Do you think that's already baked into the markets, especially the S&P?
It is baked into market expectations. We did see in the swap market, so a market that specifically tracks expectations for rate hikes, those ratcheted up today to reflect the fact that the Fed will go 75 basis points in July, which is later this month. In terms of the S&P, that's a little trickier to decipher, because the market tends to move before the economy does. And so even if we have these concerns that the Fed's moving too aggressively, it could happen that the market bottoms out and begins to look ahead to a recovery. But the weakness we've seen so far this year definitely is directly tied to a lot of the Fed's actions to combat inflation.
Big picture, do you think a soft landing is still possible for the U.S. economy?
It very well may be. I mean, when you look at the kind of jobs report we got today, it doesn't necessarily tell you that there's a recession on the horizon. There was an interesting chart from Deutsche Bank basically showing that, usually on a median basis, the first month of a recession starts with negative jobs growth, and then that carries on for about a year. Just looking at the trend, that's not what happened today. We did not get negative jobs growth. And in fact, at this pace, we will recover all the jobs we lost throughout the pandemic by August. And so the job market's not telling you that we are going to enter a recession. However, there are other parts of the economy that are slowing, such as consumer spending and manufacturing activity. And so it really is a Rorschach test right now of what data are you looking at in terms of whether we enter a recession or not.
Akin Oyedele, thank you.
Thank you.